For that matter, for all of the enthusiasm surrounding Bitcoin, somewhere in the background, gold and silver have been rocking it. And they always do in times of financial crises, whether it's deflationary or inflationary pressures that are building.
I've got a couple of financial headlines for you that I think you need to see. Plus, the main meat of this video is an interview with Danielle DiMartino Booth on the David Lin Report. I took out exact words and phrases that I wanted you to see that I think you'll benefit from seeing. And Danielle DiMartino Booth is as smart as a whip. You're going to really get a lot out of seeing what she has to say.
Well, I would like to think that that 3 bank runs in the United States or 3 failed institutions in the United States and losing one of the world's 30th largest financial institutions, Credit Suisse, would be a breakage.
Jenny Craig tells employees it will shut its doors. That's from NBC. Jenny Craig will close its doors after 4 decades in the weight loss and nutrition business, according to international communications to employees reviewed by NBC News. In an email sent to employees late Tuesday, the company said it will close due to its inability to secure additional financing, which is exactly what's been causing a lot of this banking crisis. They're trying to get more financing, and then they think they can get it, and then they can't, and all of a sudden the bank goes under.
Oh, I've got your answer. It looks like they're done raising interest rates, which I have been contending for months is no longer really the focus of Fed policymakers. They want for the additional firming. They want for the balance sheet to continue to unwind. They want for quantitative tightening to continue pulling liquidity out of the system. And as long as all they do is pause, then just by virtue of staying in a steady, in a static, at a static pace of rolling the balance sheet off, that's considered to be continued tightening. And I think that that is exactly what he was speaking to.
And as always, the entire video that I took these parts from is included in a link below this video. Plus, I'll put another link to that video at the end of this video.
But what happens if entire banks continue to go? And that's the real question here, I think, that regulators are struggling with.
And I should mention this interview with Danielle DiMartino Booth on the David Lin Report is actually a month old. But I purposely, there's a specific reason that I went back to this interview now. That's why I'm showing it to you now. Even though it was a month ago, it shows you that she knows what she's talking about. It shows you that she was right the whole way, and she'll be right from this point going forward as well.
They anticipate 3 rate cuts in 2024, but again, and that's from the dot plot. But again, they also think, or they're also communicating that they're going to continue quantitative tightening in the background. Quantitative tightening is its own form of, it's a synthetic rate hike of sorts, because as we're sliding into a credit crisis, and that's been acknowledged, as we're sliding into a credit crisis, the Fed's going to continue taking liquidity out of the system by shrinking the size of its balance sheet. That's a form of tightening.
Nothing in this video is intended as personalized trading advice for you. This video is dedicated to all the members of the Peter Leeds Army. Everybody who's not in the Peter Leeds Army, you owe a debt of gratitude to the people who are in the Army.
This is an experiment that's never been tried at home. The Fed has never been able to maintain tight policy, ever. They've always gotten rates up to a certain threshold and then very quickly pivoted and started easing.
This may be your first time here. My name is Peter Leeds, and along with my entire team, we publish our world-famous stock picks through the Peter Leeds newsletter. And I hardly ever do this, but I was reading the Peter Leeds newsletter that came out this morning. I hadn't seen it yet, so I was reading it, and I saw this one part as the first paragraph, and I said I'm going to pull that out and use it in the video today. As of yesterday, the stocks rose in 30% to $9.05 from our starting point of $6.91, placing it in our sell opinion range only 2.5 months after we first featured it. And the reason I wanted to point that out, not just for promotions, I know that's what it seems like, I'm trying to show you guys that there are stocks that are making pretty big moves. You can make a pretty good return in a very short window of time if you get involved in the right companies at the right time. That's what we help everybody do. Anybody that subscribes to our newsletter will get the benefit of all this hard work and specialized knowledge that we're bringing to bear to provide the best product to you. That's why we've been able to be in business for over 25 years now.
Is that enough to bring inflation down to their 2% target, assuming that's still their target?
Oh, that'll bring it down pretty quickly. In the middle of you know, tightening credit standards, the likes of which we haven't seen since 2008, it'll bring inflation down fast.
This is a very important headline I want to read to you. Listen to this very carefully. Stocks could be in for big gains ahead if this is the Fed's last rate hike, history shows. So understand, I believe that the stock market's going to fall off a cliff. I think it's going to do very badly. But based on history, when they start a interest rate easing cycle, that typically is the beginning of a pretty good run for stock. They looked at the last 5 times that the Federal Reserve stopped hiking rates after they had a series of increases, and they found the stock market typically shows nice returns 1 month to 12 months later. The S&P 500 averaged an 8% gain in the first 3 months and a 21% return 12 months out from the central bank's final hike in a series of rate hikes.
To the point of how lagged that is and what a mistake it is to necessarily follow that type of data. At Quill, we've been tracking every single week jobless claims, and as of the latest week, there are 67% of U.S. states have rising initial jobless claims. That encompasses 83% of the U.S. population living in a state with rising jobless claims. So if you look at other types of data, we can see unequivocally that the labor market's already turned.
We've got 3 big videos coming up soon, and anybody that subscribes to this channel is going to get to see the big inflationary bounce, de-dollarization 5 years later, what it looks like 5 years later, de-dollarization 5 years on. I've not decided on a title for that yet. Plus, the rise of the economic werewolves.
Some estimates put it around $400 billion of commercial real estate debt that's got to be refinanced this year, and at much, much higher interest rates. So that is going to become front and center, and something I dare say that Powell will have a very hard time ignoring as we get into 2023 and this credit crisis deepens.
In this next part, they start talking about delinquencies and this big delinquency deluge I've been telling you guys about for a while, and the bankruptcy tsunami. All this stuff is starting to play out right now.
But do you foresee delinquencies on loans, perhaps foreclosures in houses later in the year, or perhaps 25 basis points is all right, not that big of a difference from where we were before?
Well, it's not that it's not that big of a difference. It's that we're seeing auto repossessions running at the highest level since 2019. We're coming into a time of really battening down the hatches in terms of tightening lending conditions for households, whether you're talking about a mortgage, a refinancing, an auto loan, credit card, you name it. So lenders are really clamping down standards. Some lenders are just flat out exiting the entire business of making loans. They're saying we're going to put a pause on this for the next 6 months.
That's an example of when the overall economy starts to seize up. Businesses stop playing the role that they need to play for the economy to get back on its feet. In this next part, I have to give you a little bit of color so you understand better what she's saying. Jerome Powell is always looking at low unemployment. That's why we're not in a recession, why things are okay, the consumer's okay. But what she's getting at, the point is, and she said it earlier in this very video as well, unemployment is a lagging indicator. He's saying, look how good the unemployment rate is, but it doesn't get bad until you're already well into the recession, or once things start falling apart, then it becomes a problem. It's a lagging indicator. It happens after. It doesn't happen first, and then you go into recession. More like you go into recession, and then people start getting laid off. That's the syntax of how things are going to play out.
So, I've never been Jay Powell's biggest fan, but by the same token, if he is hiding behind lagged unemployment rate data, if he's hiding behind lagged inflation data or job opening, and I use the word hiding purposely.
Okay, she does a really good job of explaining how the economy itself and most people who borrow money are reliant on quantitative easing, monetary creation, lowering interest rates. It's almost like we're addicted to it. We need low interest rates and money sloshing around everywhere for our economy to function. We need the low interest rates. We need the quantitative easing. That's the point of this next section.
And maybe that gets us back to a place where we don't live in a world in which the US economy can only subsist on zero interest rate policy and quantitative easing as constant states. And we have to bear in mind, since December 2008, when Bernanke took us down to the zero bound and launched quantitative easing, the economy has been in a very dependent state ever since then. And the two attempts at normalizing policy have failed. The odds are stacked against Jay Powell to succeed because the economy is very visibly in need of much lower interest rates and for quantitative easing to be resumed instead of quantitative tightening. It's ugly stepsister.
And I left this next part in because there's a couple of good charts that I want you to see in David Lin's report. So check out this chart.
You have a chart called The Demise of U.S. Community Banking, very strong words, Danielle, and it shows the number of U.S. FDIC-insured commercial banks having come down over the last 20 years. First of all, why do you think this trend happened, and what do you think the future of banking in America will look like following this crisis that we're seeing right now?
Well, sadly enough, going into the great financial crisis, small community banks held 55% of all commercial real estate loans. Today, that number's 70%. So they're overly exposed to commercial real estate loans. That's going to put them on very weak footing. It's not the fault of their own that they went down that path. And on top of that, they have less of a cushion in terms of the coverage that they have for their uninsured deposits, which is very problematic in this high interest rate environment. And that is why there are calls for Janet Yellen to backstop the uninsured deposits of all banks.
And you guys know that when you see an inversion in the yield curve, there's always a recession that follows it. When you have a longer term bond paying you less than a shorter term bond, that's an inversion in the yield curve. But we're seeing a few, and check out this chart. I'll show you a bunch of inversions that we've seen over recent history.
The yield curve has been inverted since July 2022. Usually in the past, not always, but usually in the past, a 6-month period of inversion has led to a recession.
As always, if you have any questions about anything at all, send an email to questions@peterleads.com or call us 1-866-MY-LEADS, and we'll talk to you on the phone, a real person, not AI, not a call center. It's a human being.